Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, June 27th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So today's key macro events are evolving global liquidity dynamics, the PBOC's hands are tied, and an update on AI picks and shovel stocks. In terms of market implications, the corrections across the crypto market call into question the consensus belief that global liquidity is poised to accelerate sharply into 2025. Our Bayesian analysis of leading indicators of the global liquidity cycle currently suggests global liquidity is likely to be, at best, flat over the next quarter or two. The PBOC pulled back on supporting the Chinese economy to defend the yuan in recent months. While we do not believe this constitutes a structural shift away from combating deflation, we do believe it may represent a cyclical shift, especially if the Fed cannot continue suppressing the U.S. dollar. We do not believe relative performance has peaked for AI stocks or the growth or inequality factors broadly. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one's titled Oil Prices Linked to Recession. It says, good morning, team. I've been analyzing various periods when the Fed was hiking interest rates. Interestingly, during soft landing scenarios, the price of oil remained flat or decreased. Conversely, in hard landing scenarios, the price of oil increased. From this perspective, could it be reasonable to consider oil as a potential hedge for a recession? I'm interested to know when anyone else has reached a similar conclusion or has been supported or seen supporting data. So that's an excellent analysis. We've done a similar analysis like that. I want to say the last time we updated it was sometime in 2022, but our analysis concluded the same, was that oil price spikes in the oil price have historically preceded recessions. Specifically, whenever you've had a doubling in the oil price on a 2-year basis, historically you've seen that be a leading indicator for recession. And so, certainly in that context, oil would be a good hedge for recession because, again, historically speaking, oil has spiked leading into recessions. Now, that's assuming that you have a recession that is caused by a sharp acceleration in inflation and a pullback in consumer spending. You could have a recession if for instance, that's more credit driven, much like what we saw last spring with respect to the regional banking crisis. And so that's the risk of using something like oil, which is a high beta risk asset, a commodity, as a recession hedge. If the recession is emanating from stress in the banking sector, which again we currently see as a very low probability event. But if that were to be the case, then you're going to have outright deflation from the start. And so that's something to be aware of, and you need to be pay close attention to that as an investor. So obviously, if you're heading into a recession, your best bet as a risk manager, as someone risk managing a portfolio, is to put on the deflation playbook in asset allocation and portfolio construction terms. And if you need help figuring out exactly what that means in terms of your gross and net exposure to the various asset classes, or the factor long short bets you're making within the asset classes, that's asset allocation and portfolio construction for those who are not yet familiar with our nomenclature, or Global Wall Street's nomenclature. But if you need help with those asset allocation and portfolio construction recommendations, and more importantly, the timing, which we specialize in, then obviously you should be a client of 42 Macro. So we'll wrap it up there. Darius Dell presenting our macro minute for Thursday, June 27th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.